I just wanted to talk about some of the rules you should throw out. And some of these are going to be for maybe I don't know, a couple of years in your journey, but I'm going to include some of them that are for the beginners. Frankly, I'm not going to be a good resource if you've been around for 20 years. Maybe if you want to get entertained by noshing at it, by X points, then you can, but otherwise, it's just like at that difficulty level. So let's start out with some beginner things that I think people should definitely throw out. And this is going to be subject to interpretation, but I think that starting out with like real live money when you're deciding to do the most insane of things that you're going to trade or you're going to self-direct, if you can't paper trade, you're not going to be able to do successfully with money. I just don't think it's going to happen. Now, a lot of people are going to say you're going to become a little bit more reckless, and that's absolutely it. But if you can't get it together on paper, I don't think you're going to get it together live. Because something happens to your brain when you use your money. And I think you just need to figure out if you're an impulsive person or not. And if you're like me, I laugh that I'm a degenerate because I've done some pretty incredibly stupid things in my life. And I find value from doing things off the cuff without a lot of experience, because sometimes you just got to go out and do it, but you're fucking around with your money and the opportunity cost of investing is really high. People have literally told me stories where they're messing around with their retirements trying to self-direct when they've never proven to themselves that they can time the market. It just seems not prudent. That's in terms of trading. Now, I've done both. I have multiple accounts, which I hope you guys will organize yourself that way. And obviously, your first step, if you're going to mess with anything more than something that is, I don't know, a dinner for you, right? Somebody's dinner could be $400. I don't know. That's not my typical dinner. Try to size it for yourself. And I would personally go and seek out a licensed financial advisor, because I'm not one. I'm just a person on the internet who's an idiot. I have some successful trading strategies. I've traded successfully before, but anybody who's been long enough in this is that eventually some of the best alpha dies. And so I would personally know that you're on a marathon, but you've got to be like running at your top form all the time to get that performance that you're looking for. You've got to beat your benchmark depending on your goals, right? And so to keep that up is really difficult. Okay, just to summarize that, if you're starting out, go to paper first. If you can't do it on paper, you're not going to be able to do it. Obviously, before your paper, you're going to do your back test and all of that. So again, the rule where you start with live money because you're not going to take it seriously, I think is a total, I just think it's a really bad idea. It starts you with bad habits, which is that you shouldn't have caution. But that's literally what the business is, risk, right? And that's one really easy way to avoid it. Oh, hey, redemption. So that's one. Now, I really like the ones that people brought up. So I think there were three. There was Coro, Millennial, and a new person. They had talked about that PE is a key metric. So a couple things have happened with PE lately. There's a lot of accounting rules that changed, it seems, since 2015. But one key one that I really like to know about PE was that investments, even though they're not sold yet, just the current market price is marked down and put into the income line. If you know what PE is, which is price over earnings. Earnings refers to income or earnings per share. That's unrealized gains, or just what currently your position is marked to goes to the income line. So you probably don't want to take that as income, right? It's more of a gauge of where they are, or they could potentially be. But when you look down into seeing what these businesses bought over the last, couple of years, there was a lot of mania and a lot of kind of crazy valuations that I don't think will be supported going on. And we've seen that. I did about a year and a half ago, I did a video on the end of a business cycle and what we're going to see. And the beginning stages of that was bonds go first, which we're already seeing. 3 years of the largest bear market in bonds since ever, and repeatedly. US based, by the way, if there's international people. And then you saw growth stocks fall off the map. If growth stocks have had incredible drops, you're like 70, 80%, 90, then what does that mean for your income line? That those earnings weren't exactly real, right? Is PE really the right metric? I don't think so. I think you need to start looking at a balance sheet and realizing what the tricks are. Because I've seen so much grift in the last 2 years. It feels more than usual, but I think it's really something that you're going to trip over. And you need to take valuations in the context of what is the valuation of money, right? Kind of what the market is, right? Just think about it in practical sense, even if you don't know anything about stocks, right? Think about a house. Why is it that one house can be $1 million, but it's the same size as a house across town, or it's not the same size of a house across town, or maybe it is, but why is that one $1 million? Because that market around there is hot, right? So when you're looking at like the IPO market, you know that it's not really its favored time. That was 2020. Now, if you're looking at stocks that actually make money, might be mega cap, which is in the S&P 500, you're going to consider those in a different light. And I think that some of that is going to trip up new people, and that's why PE metric fools a lot of people, right? I've never seen PE be useful to me. Anything that I can't trade off of is immediately just not a concern of mine. And when I hear people talking about it, I just go, what are you seeing? What are you seeing in data that gives it to you, or that gives you an idea or makes it useful to you? And so I think let's move on to my third thing, which is start thinking in an evidence-based mindset. A lot of people on this app and a lot of people in trading investing say a lot of things that have no basis in fact. That doesn't mean that if somebody says something odd or doesn't say what everyone else is saying, that's your judgment. Is you need to start building skills like back testing, research. Even if you don't do back testing, you better learn how to read someone else's research. And if it's not disseminated research that someone has either posted for free, yeah, there's rare stuff like that out there, which is super rare, but maybe start learning how to read papers or books. But you're not going to find it in a podcast or a tweet. A tweet is basically like a hint. Is that a chat that I don't see? Let me see. is my first Spaces, so I don't know. But hopefully somebody listens to the recording. One quote. Oh, that's Millennium. Thank you. So I think you really need to start picking up like a really good filter of what kind of nuggets are you going to keep and what nuggets are you going to throw away, because people can be really overwhelming in their talks, right? And if usually people aren't talking about I think a key one to discern if someone trades or not is they'll start talking a lot of details about the behavior of an asset or the history of something versus just talking about what they think they know, right? It doesn't mean that that's not that's not a thing that you look for, but for example, I listened to a YouTube last night of a professor and who posts a lot of his back tests and actually trades, which is hilarious. But he's a former professor, and you can see how he talks about the history, about the detailed asset structure, when it tends to turn, the relationship, what market structure you see it in, what market structure you don't see it in. And it can be really telling that he actually trades, or they talk about upside and downside risk, right? Usually you'll hear people say, oh, God, it's hard to remember the dumb stuff because I'm literally trying not to remember it. I don't know. It's going to go to the moon. Okay, what's the risk here? Right? Like, am I going to own an asset that has the potential to drop 80%? That doesn't seem such a great idea, right? Because if you go reach out for those assets, the problem is, one, your win rate goes down. You need a lot of reward to outweigh that. Two, how do you get back to even, right? You need to spread out your risk and have a lot of shots at it. The way that I think people that talk that are actually successful in trading are thinking about how many shots they have for how much money they have out of their portfolio, right? Do they take a position, take 10%? Do they take a position that's 5%? And that's great. That's like more of a mathematician, but really, how many shots is that out of your total bankroll or your portfolio? 5% is going to be 20, right? So you got to think, if I got to win 20 to 1 just to come back to even, I think, yeah, I'm not great with hand math, but anyways, that's the way you got to think of, where am I going to come back to even, and where am I going to actually start making money, right? And where is that point that I need to get in and out of this asset, right? For example, right now I'm running a lot of corporate governance, and I know enough about my strategy and all the types of signs that I know if I get in the third day after the news hits that I get like a 1.5 return on that, right? Without knowing that, I don't know how people trade, right? I don't know how they understand timing or not. And what I have to do is slice up all the asset prices and see how it relates to events, not just like wing it by the seat of my pants. And I'm not really sure why nobody talks about that, except for the fact that it's pure alpha. And maybe they drop a little bit of hint, but you definitely don't want to be listening to people that don't think about things in this way. Or at least I've never been able to be successful out of people who just talk, I don't know, who don't have a clear understanding of timing or the magnitude of the risks and the rewards. Yeah, that's what it is. Or the relationships, like what really matters. And what's really funny is I call it, okay, so for the fourth one, I call it the Reddit effect. Okay? So there's something that I noticed on Wall Street Bets. So I did a lot of data collection on Wall Street Bets. I even used some of it to trade during 2020. And for about a year, it worked to trade off of what Wall Street Bets was talking about. It was the most bizarre time ever. And then the edge just disappeared. It was no longer there, which is how it usually happens. But anyway, so what I noticed was the longer the post was, the more upvotes it would get. And I was like, do these people really know that this person and what they're talking about is accurate, significant, verifiable? No. They're just responding to, I think, like signaling. I think they're just responding to signaling where if you talk more and it sounds good, that person must know what they're talking about. Like I call it the orgy of facts. And I just don't know that that was accurate, right? A one sentence response could be just as valuable or more valuable than a 500 word one. So I definitely think you should be really cognizant of the Reddit effect. Just because somebody knows a lot about something doesn't mean that they know how to trade it. Doesn't mean that they know that it's an investable product. Doesn't know anything about anything. Just maybe they looked up a lot of things in Investopedia and they sound smart. So I want you to be very careful of that kind of thing. Just because somebody sounds professor-like doesn't mean they know what they're talking about. And I make memes because I have to make fun of it. I just can't stand it because I've gone through the data. I've spent like months of my life working with some kind of indicator or like PE, and I just find absolutely no value in it. And I don't understand why people continue to quote it. And it's really tough as a content creator because it means I have less content to talk about. But what am I supposed to do? Anyway, so I definitely think you should be careful of the Reddit effect where just because it sounds good doesn't mean anyone knows anything. And I saw something floating around a paper when it talks about finding alpha on Twitter. And they were talking about that the smaller accounts have more value. Actually, bigger accounts have a negative effect, a negative abnormal return. It's just so funny. Because think about it. Okay, I want you to do some piece of homework, which I think will be really fun if anyone makes it this way, this long and this detailed rant. I want you to identify an area of competence that you have. Maybe you're an engineer. I don't know. Maybe you're a computer science engineer. Maybe you are, I don't know. Maybe you put on makeup for a living. Maybe you style hair. Maybe you, I don't know, are in food service. So you know a lot about food service businesses. And I want you to identify that area of competence. And then I want you to read either mainstream media or maybe a Market Watch article, maybe a Seeking Alpha article or mainstream media, I don't know, like CNN, Fox, about that topic. And I want you to just remember the feelings that you're having. That is the dumbest. Maybe you'll have feelings like, what are they talking about? Just like pure confusion. Or just, that feeling where that person is total bullshit. Keep that feeling and then realize when you read finance that you don't know enough to have that feeling. So remember, what about it made you think that? Was it a detail? Was it?
This space was downloaded via spacesdown.com. Visit to download your spaces today.
Notice the patterns. And you'll start to notice the patterns of people who don't know anything. And once you start to trade, you'll start to notice the people that it's so obvious that they don't know how to trade. I can't tell you the number of people that suggest that you should just go put live money on untested strategies, and you're like, that's how you waste a lot of money. Because I'll tell you, there's so many strategies that seem great on paper or in the back test that you forward test, and you're like, well, that doesn't work at all. And so you'll just start to notice these things. So write it down. I can't encourage you guys enough that flying by the seat of your pants is another thing that you should just throw that rule book out of the fucking window. Okay, Twitter hates it when I curse, so I'm trying not to do it, but I'll do it. So throw that one out the rule book. What else? Let me think. What was the one that Coro said? Can't remember. I remember millennials. I remember the PE one. What was the other rule? Here, I'm going to go into my mentions and see what it was. Okay, millennials got the do what has worked for everyone else, which I think I covered. What's the other one? Oh, I should just click into that. Dollar cost averaging. Oh, this one's great. This is one that you can really tell people don't know what they're doing. And it's really tough to see it because you got to see it. I don't know. You got to do the math. So, what is dollar cost averaging? Okay, a lot of personal finance people will talk about this. Okay, so it's, I don't know, you bought some stock ABC, and if there is a stock ABC, I'm not recommending it, obviously. And I make no recommendations. I don't have a license. I'm just a retailer on the internet trying to help you avoid the mistakes that I did. Anyways, so stock ABC, maybe it's $10. You bought it, goes down to 8, and maybe you'll think I'll buy more of it. Dollar cost averaging is similar, right? You buy more of it as it goes down to lower your average. But typically people will take this a little bit extreme and they will double the amount that they originally invested. For example, maybe they took $100 into that $10 stock. You're going to have 10 stocks. And this time they put in 20. And so they double the amount that they originally had. And if you do that mathematically over and over again, technically you would have had to have an infinite bankroll, or the amount of money that you have available to invest in new stocks. And so if you do something like that, well, nobody has infinite money, so you're going to fail. The problem is when you look at the distribution of returns, you'll notice that it's just a little tiny blip on the left side where the negative returns are. And so it'll fool you as if it's a betting strategy, so to speak, that works, and it just doesn't. But they'll hear really smart people talk about how this thing works, and it can if the asset never goes down. So you're making a ridiculously large bet because what you're doing is you're not limiting your downside. And what is risk about? We have two jobs, risk and time. And if you're not managing risk by deciding that the risk blows out, you're doing exactly not your job. And so I think dollar cost averaging is something that definitely needs to be thrown out because, well, for traders, it's a really not a great idea. And I'm sure there's some people who do well with it, and that's fine. But I think it's a really dangerous tactic because I've seen how people get out of trouble and they just say, I'll average down again. And I'll average down again. If you're not really disciplined, and I haven't met a lot of disciplined people in my life. A lot of people will say they are, and I just think human nature is totally not. I don't know. I think we're just built not to be disciplined. And so leaning into something that depends on whether you're disciplined or not was just a total recipe for no success. And you're dealing with really dangerous concepts, which is your money. Your money affects so much of your life, and why you're going to lean into an area that's not really going to give you a lot of good feedback. It's not going to be healthy for you. I've seen it not be so great for a couple people. And so if you know that you're that kind of person, stay far away from the idea of dollar cost averaging, even if it's not a full martingale, because you can do partial ones. Just because you're averaging down once or twice is still, you're still blowing out your risk for what? Right. And there's a really great mathematical relation, which is you can actually have edge. You could actually be successful and absolutely destroy your account because you decided to use too much of it. And nobody really gets it until you do the math, but it really does make sense. If you don't have extra opportunities to fail, would you have ever made it in life? Imagine that, okay, I'm going to go ride a bike. I'm going to learn how to ride a bike. But I'm going to give myself one chance, and I'm going to do it on the side of a building with a very tiny ramp. And if I don't make it, I'm going to fall off the side of the building and die. Everyone is going to think that you're crazy. But when it comes to trading, for some reason, we don't think that's crazy. So I think that people forget everything that they knew about life, and they decide to throw it out the window because YOLO, I don't know, because you could possibly gain something. Why not put on some training wheels and try to teach yourself how to ride a bike? Teach yourself how to ride a bike by giving yourself a lot of chances. And so essentially that's how the math works out, is that's what you're trying to do. You're trying to give yourself more chances to make that money because you really don't know if that trade is going to go well. Yes, I know. I sound confident that it's what it is, but that's because there's a probability and a magnitude in it. The confidence comes from I have a good probability and a good sense that the money's going to come my way if I just take another shot. So give yourself a lot of shots and try not to lose your sense. Try to think of things in terms of a situation that you've encountered before and make it make sense with investing, right? I've seen so much crazy shit. I wish that I was on Twitter like 2020 because that was some of the craziest times. I could not convince people to do their due diligence about stocks. And I was like, why is that? And I guess it comes down to greed or whatever. They would spend hours researching like a mouse or a computer. Feels like a dream, doesn't it? I'm at a coffee shop. They would research 200 hours, 100 hours, 20 hours on a mouse, a computer. But when it came to a stock, they were like, yeah, fuck it. It's a solid state battery. And they have new advancements. And I go, what do you know about the battery business? And they're like, yeah, but this is the next thing. What are you doing? Research it a little bit. Nah, I'm going to buy it. Okay. So you spend 20 hours on a mouse, but a stock? Nah, fuck it. How much are you going to put on that? $10,000? Why? Why, dear God, why? So I think just use the things that you've picked up in life, which is if you're going to do something risky, you should probably learn a little bit about it. Go to those trade journals, right? Think about your areas of competence and where is it that you go to be interested about that hobby. If you have an interest in hobbyist planes, you probably read a magazine or a publication about little airplanes. I don't know what people are into. Look at me. I'm a nerd on the internet who likes stocks. Anyways. So those are kinds of some of the things that I guess are rules that I would avoid, even though they're really popular. Oh, look, CP responded. Thanks for reply. When looking at a group of stocks over a time period, PE ratios vacillate primarily from buybacks. Many businesses can name their PE through tactical buybacks. Fewer available shares equal better PE. You gotta love the shark game. And it's so funny how how do I call it? The pure, how do I say this? The objections that people have to me when I do Twitch streaming or when I will tell people something that I found, it's just like the pure naivety. I don't know. You can tell that you're a mark. You know what I mean? Don't be a mark. You guys got to understand that these people are professional fucking legal grifters. It's not illegal, but it is a grift. And I know if you look up the definition of grift, which someone did do on me. Hold on. Anyways, I would understand that it's a grift. It's a legal grift. It's more like you are experiencing a personal grifter, a professional grifter class. Basically, they have been trained since birth to understand how to extricate money from people. That's who you're dealing with, right? Think about it. They've gone to elite colleges, only top 10 schools, or people, make it into Wall Street. And so there's somewhat of a homogenized culture that you're dealing with. Mm-hmm. So there's somewhat of a homogenized culture you're dealing with, right? They teach them how to act. They teach them how to be likable. A lot of these things are popularity contests, right? What are the key things that they can say to convince you to invest in their company, right? A CEO's job is to A CEO's job is to convince you to invest. So you got to step out of that there are investor protections, especially with the late cycle, right? The SEC is just too busy building a case, right? The government comes around to clean up a mess, not to prevent you from a mess. And so you got to have that sus face on and understand who's trying to grift you, right? So what are the grifts? How can you tell a grift? The number one way, especially about a topic, is to go to a trade publication. And this is a technique that I don't think a lot of people talk about, right? So I have a list of trade publications for certain topics. For technology, and not your mega cap, but your kind of startups. And this is for longer term investing, because that's really what I've done in the small ones. There's no decaf. I just want a coffee. Give me a sparkling water. Yeah. Anyways, so the growth that you're looking for is going to be found or you're going to find it out by reading like TechCrunch or Hacker News, Stack Exchange. You're going to read Blind. Kind of start to search that company and see what they're talking about. The gossip's where it's at. The people who are around know who the movers and shakers are. And you can get a sense from that. If it's for banking, maybe American Banker, Going Concern, if you're into corporate governance, that's going to be a great one. If you're into entertainment investing, there's Hollywood Reporter. I felt like I saw the demise of Netflix there when what was her name? Holland left. So she was a producer who had really tight relationships with the talent who would build these new shows, and they would always talk about their passion and how they had freedom to create. And you that too with Disney having its shit is a lot of the creators are talking about how it's just not the same. And of course that can be the retraction of money, easy money. But so trade publications are a big deal. It can help you separate who's a good idea and who isn't. So again, if you have any opinions about this space or what I talked about, I'd love to hear from you guys, especially if you have any techniques or maybe the details, maybe your list. Maybe you want to tell me, hey, Rita, your method sucks, whatever. If you tell me in a constructed way, I'll hear you.